All right, today we're diving into a topic that is, no joke, one of the most critical parts of a company's survival, but it's something a lot of people just gloss over. It's the absolute lifeblood of a business's day-to-day operations. And if you get it wrong, it can be totally fatal, even if on the surface, everything looks amazing. So let's get into it. The secret financial engine that keeps businesses running, working capital.
So let me ask you this, because it sounds like a riddle, right? How can a company be totally profitable on paper? The income statement looks fantastic, but all of a sudden they can't pay their people. They can't pay their suppliers. How on earth does that happen? Well, that exact paradox is what we're going to unpack today.
Okay, so let's just jump right in. In this first part, we're going to see exactly why a profitable company can go under. And it really all boils down to this super important and, frankly, often misunderstood difference between profit and actual cash.
There's a name for this terrifying situation. It's called technical insolvency. And here's the thing you have to remember. Profit is just an accounting idea, you know? It's your revenue minus your expenses, but cash is the real money in your bank account that you need to pay bills today. You could have millions in assets, like invoices your customers haven't paid yet, or a warehouse full of inventory. But if you don't have the cold, hard cash to make payroll next Friday, you are in some serious, serious trouble.
And listen, this is not just some business school theory. As our source material points out, big historical events like the Asian financial crisis back in the late 90s taught this lesson in the most brutal way possible. So many solid, profitable companies went bankrupt for one simple reason: they ran out of cash. They learned the hard way that liquidity, which is just your ability to pay your bills right now, is every bit as important as profitability.
So, if a lack of cash is the disease, then what's the cure? Well, it's this thing called working capital. And really understanding this concept is the key to managing a company's financial health. To put it really simply, working capital is just the money you have on hand to run the day-to-day show. The math is easy. You take your current assets, that's things like your cash, your inventory, the money customers owe you, and you subtract your current liabilities, which are the bills you have to pay soon. If you get a positive number, that means you have a financial cushion. You're in good shape.
You know, a really great way to think about this is like it's your company's financial metabolism. It's the energy that's constantly circulating through the business, turning things like inventory into sales, sales into cash, and then using that cash to pay the bills and start the whole cycle over again. A healthy, fast metabolism keeps the business running smoothly, you know? It's lean, it's efficient.
Now, managing this stuff isn't as simple as just trying to pile up as much cash as you can. Any financial manager is constantly facing this fundamental conflict. It's a really big trade-off.
And this right here, this lays out the core dilemma perfectly. On one side, you've got liquidity. That's all about safety, right? Your goal is to always be able to pay your bills, so you hold lots of cash. But the problem is that cash is just sitting there. It's not really working for you. Then, on the other side, you've got profitability. This is all about growth. You take that cash and you invest it in new projects, more inventory, better equipment to get a much higher return. But the risk? Well, you might not have that cash ready to go when a big bill suddenly comes due. It's a constant balancing act.
So trying to find the sweet spot between that safety and that growth has led to basically three different ways of thinking about this. Three distinct philosophies for how companies fund their working capital. So how do they decide? Let's break down the three main schools of thought.
Okay, first up, we've got the aggressive approach. And it is exactly what it sounds like. This strategy is all about chasing profitability, and it's willing to take on some pretty big risks to get there.
So here's the logic. You match how long you're borrowing money for with how long you'll have the asset. Makes sense. Long-term assets, like a building, get paid for with long-term loans. But, and this is the crazy part, all of your short-term stuff, even the base level of inventory you need all year round, gets funded with short-term debt. It's a total high-wire act. You're constantly having to roll over those loans just to keep the lights on.
The upside? It's pretty clear. Short-term debt is usually cheaper, so your financing costs go down and your profits go up. But the downside is absolutely massive. If the credit markets suddenly get tight or your business just hits a slow patch, you might not be able to get those new loans you need to pay off the old ones. And just like that, boom, you're technically insolvent, just like we talked about at the beginning.
Now, let's swing to the complete opposite end of the spectrum. This is the conservative approach. This philosophy is all about safety first, last, and always, even if it means leaving some profit on the table.
A company that's this conservative uses stable, long-term money like big loans or investor cash to pay for pretty much everything.
Not just their buildings, but all of their working capital needs, even for their busiest season. Think about a toy store in, say, March, already holding enough cash to cover its entire Christmas rush. What that means is, for most of the year, they've got a ton of extra cash just sitting there, not doing anything.
The big advantage here is just peace of mind. The risk of running out of cash is practically zero. It's stable, it's simple, but all that safety comes at a price. That idle cash isn't growing the business, that's a huge opportunity cost. Plus, long-term financing is usually more expensive, and that eats into your profits. So yeah, it's safe, but it's really not very efficient.
So, as you've probably guessed, most companies don't live on those two extreme ends. They go for something in the middle, a balanced approach.
This strategy kind of splits the difference. You use your long-term money for the permanent stuff, your buildings, equipment, and the base level of inventory you need all the time. But then, you use short-term debt flexibly only when you need to cover those seasonal spikes or temporary needs. It's like a retailer using their own capital for the store and their basic stock, but then taking out a small, short-term loan each fall to load up for the holiday season.
So what this does is it tries to get the best of both worlds. You get a safety buffer from your long-term funding, but you can still use that cheaper, short-term funding to boost your returns when you need it. It's a compromise, really. You're not going to get the absolute maximum profit you'd see with the aggressive strategy, but you're also not staring at that same terrifying level of risk.
So we've looked at these three pretty different ways of thinking about it. And the natural question, of course, is which one is the right one?
And the answer is, well, it depends. There is no single correct answer here. A big, stable utility company is probably going to lean very conservative. On the other hand, a fast-growing tech startup might have to be aggressive to fuel that expansion. The right choice is a strategic one, and it really just has to reflect the company's industry, its stability, and frankly, its stomach for risk.
And just to bring this all home, think about your own finances for a second. Are you aggressive, investing every spare penny for that maximum growth? Or are you conservative, keeping a big emergency fund in the bank just in case? Or are you somewhere in the middle? Because understanding these philosophies isn't just for big corporations. It gives all of us a really powerful way to think about risk and reward in our own lives.